it's not like it doesn't hurt. It hurts. Do I sit here every day and say, oh my God, I suck at this and what the hell am I doing? This is after 20 years. I haven't had a down year now in 21 years, right? But I have a down month, which is complete. I usually have 2 to 3, sometimes up to 4 down months during the year. But it doesn't matter. I have a down month this month, which is well within expectations. And I'm still like, oh my God, my process doesn't work. I suck. I don't know what I'm doing. We all go through this, right?
What's going on, everybody? I have a special guest today, Jason Shapiro from the Crowded Market Report. He has 30 plus years of trading, and he's known for being featured in the Unknown Market Wizards book. Instead of going much into detail of Jason's specific personal background, if you want to learn more about Jason, I'd highly recommend going to check out the Market Huddle podcast, where he was recently interviewed, and they dive deep into his background and kind of how he came to be who he is today. Today, I want to focus more on process. Specifically, there's 4 things that we can control in the markets. So that's how this is going to be broken down with timestamps in the description. Those 4 things are going to be what to buy, when to buy it, how much to buy it, and when to sell. So 4 key things that are very important to traders. Let's hop right into it of what to buy.
Okay. So for me to put on a trade, I'm looking to take the opposite side of very crowded trades. And I'm sort of turn picking. So the first thing of what to buy is I'm looking for the trades that are the most crowded. And I use the commitments of traders data to help me determine what that is. So I take that data, I index it. And when my index sort of reads 0, it means everybody's very short. I'm looking to buy. When my index is reading towards 100, it means everybody's very long and I'm looking to get short.
Awesome. So when it comes to what to buy, there's a specific tool that you use that is known as the Commitment of Traders Report. You want to walk us through what exactly is the cftc.gov and what it is that you look for specifically to get that data?
So they release the data every week. It shows the net positioning by 3 groups. And those 3 groups are the commercials and then what I call the large speculators and the small speculators. And that's just broken down by people that open up futures accounts. If they are a commercial, meaning if they are someone that is just hedging like a gold miner or oil driller or whatever, they get to post less margin if they are a commercial. So they become commercials. Everybody else becomes a speculator, me, you, whoever. And the difference between large and small speculators is they really call them reportable positions. If you go over a certain size, and each market's a little different, but if you go over a certain size, you have to report that position, which is their way of trying to stop people from cornering the market. So if you are reportable, I call it a large speculator, and everybody else is essentially a non-reportable or a small speculator. So the commitments of traders will then show where those 3 groups are positioned. And I am looking for extreme reading. Let's say if I want to get long something, an extreme long by commercials and an extreme short by both the small and the large speculators. And that's my first screen as to whether I'm going to get long something.
Gotcha. So if I pull up the cftc.gov and I go here under market data and economic analysis, it pulls up an option to hit the commitment of traders. So is that where you download this data from?
I don't personally download the data from there, but my partner does.
Okay.
And he creates the charts, and then the data goes into my charting system and it goes into my index, and that's how it all gets developed. But yes, you can download the data there if you know how to do stuff like that.
There's a couple different options here. So I just wanted to, if somebody were to come up onto this website to pull some of the data and start to kind of dig into the nitty gritty, I noticed that there's options for agriculture, petroleum, natural gas, and products. And then they have disaggregated futures only, disaggregated futures and options combined. Is there any, and then they have long format, short format. There's a bunch of different options. Is there anything specifically here that you're looking at, or is he kind of compiling all the data for you?
So I think, I keep it as simple as I can. I do what is called the legacy report, which is the way that they have been reporting this data forever. In the last 15 or 20 years, they have tried to change it a little bit and disaggregate it and do that and add options to it. I don't do that. I'm not saying that there's not value in doing that. There could be. And people that are looking into this data or look into this data certainly should go back and look at all this data. We have done in the past. What I found was the best way was to keep it simple and keep it the way that it always was. But if you're into options and you think options add value, then certainly the futures and options data might help you. It's all up to sort of everybody to take a look at and test themselves. We have, like I say, I've had people work for me that have done a lot of testing with this, and what I use is what ended up being the most reliable testing in our view.
Gotcha. So you said the legacy reports. I noticed that there is an option there to download the legacy reports. There's short format, long format, and then there's a bunch of different options as far as like Chicago Board of Trade, Chicago Mercantile Exchange. Is there
that's just all the different markets. I mean, we download them all because we look at all the markets. But
okay, cool. So you look through that data now. So that's your tool. That's the data that you're aggregating. But how you aggregate it is also important to determine what it is that you buy. And you talked about extreme levels being more of a contrarian type trader. Do you have a chart that maybe we can walk through right now, something that you might be looking at?
So this is our chart of the heating oil commitments of traders. And you can see like the red is the commercials. So you can see how short the commercials are heating oil, right? Compared to history, right?
Yeah.
And the blue is the large speculators, and you can see how long they are. And even the yellow, which is the small speculator, you can see how long they are, right?
Yeah.
So they're super long. Commercials are super short. That is showing me that I am looking to short heating oil at that point.
Okay. And once again, I know you've already mentioned this, but while we're looking at the chart, it might help to kind of walk through really quick again, the sum of commercials, and then the large speculators, and then the sum of small speculators is specifically what it is that you're looking for, and then what those actually mean.
So that's just the net open positions of these three groups: the commercials, the large specs, and the small specs, right? So in other words, commercials are super short here and the speculators are super long here. And then I take that and I index this data to give me, a 0 to 100 type of thing.
Okay. Something that I'm noticing is if somebody were to just download this report as is, they might see a large number, but it might have no meaning whatsoever because they're not looking at the prior data, correct?
Yes.
Okay.
Yes. And then, it's tricky. That part is very tricky because you're indexing it. So it's just like an RSI as an index. Are you looking at a 30-day RSI? Are you looking at an 80-day RSI? Are you looking at a 400-day RSI? At what level do you want to do that, right? And that was all determined for me a number of years ago through back testing and that type of stuff, right? And this is probably the hardest part of the COT is because that number can be a moving target, what was the best look back period at one point might be a different look back period at a different point, so when I set my look back periods, I really tried to do it in terms of not finding the single best one that might have caught one trade. Obviously these are typical back testing things, but tried to find, an area of grouping where it was the most steady over time.
Gotcha. Okay. So this is how you're determining really what to buy. And then and this is using the commitment of traders, aggregating all the data, and then looking over a course of period of time. Now, when it comes to when you actually put on a trade, are you using something like technical analysis? Are you using a specific indicator? Or if you just see an extended chart, you're like, okay, maybe here, or is it a news article? So what specifically will make you go, okay, now is the time to put on an execution of this?
Yeah, I think this is probably more important than the actual commitments of traders data. And I think that this is something that's important for everybody, no matter how they trade, which is what I'm looking for is a market confirmation. And for me, what that means is, okay, so here's heating oil. I'm looking to get short. Where am I going to get short? I want the market to sort of confirm for me first. And I look at it as a news failure event, meaning, so everybody's long heating oil. I start paying attention. Why is everybody getting long heating oil? Is there an inventory issue? Is there a storm coming? Is it this kind of stuff? And then I want the market to confirm that. So let's say heating oil inventories are coming out very, very low, which is bullish, right? So the market's been going up, everybody's getting long. So now they're crowded long. So now we get a new inventory number and it comes out again, very, very bullish. Market should continue to go up, but it doesn't. Probably goes up on the news, turns around and fails that day and closes down. To me, that's market confirmation for me. That's news failure, market confirmation. So I short it right there. They're super long. Market no longer goes up on good news. I get short.
Okay. So that makes sense. So you're really approaching this. It doesn't seem like, a lot of my people that are subscribed to this channel, we do a lot of technical analysis, but here it seems like you're looking for a very crowded, obviously trade one way, and then something to break or fail to really make that execution.
Yes, I'm not using any kind of really technical analysis type of stuff. It's just really classic kind of tape reading. It's the old sell the news, right? Buy the rumor, sell the news.
Awesome.
I'm basically selling the news. Well, once it's crowded, I am then looking to sell the news.
Gotcha.
Or if I'm buying something because everyone's crowded short, then I'm looking to buy the bad news. Which, the perfect example for that, since most people probably don't follow heating oil, but everybody kind of follows the stock market. If you look at the October low in the stock market, that was on a very bad piece of news, right?
Yes.
Market bottomed the day that the CPI came out. The CPI was stronger than expected. Everybody was, even more then than they are now, very focused on CPI towards the end of last year and all of last year. We had the largest CPI number come out, larger than expected CPI number come out. The market went down, closed up on the day. That was a news failure event in the stock market. That has, to this point, been the exact low of the stock market.
That's a great point. Okay, that's a good example. So when I'm looking at this, you only trade futures, correct? Or are you trading any of the equity markets or options, or is it just futures specifically?
I trade futures, but I trade like the equity futures, NASDAQ, S&P, Russell, Dow, but I don't trade individual equities.
Okay. Okay, so for example, on the October low, did you execute a trade on that specific day, or was the chart specifically for you when you're looking not at a candlestick chart, but at your specific charts? Was there an overextended reading or was it a crowded trade?
So in October at the low, it was not a crowded trade. So I did not get long that news failure.
Okay.
What ended up happening, and the way people trade and when they get crowded and what they decide to do is sort of hard to predict.
Right.
What ended up happening was people sold into the rally. And by January, they actually were very crowded short. And then we had a news failure in January, at which time I got long.
Okay. So that was the perfect time.
It ended up being
the perfect time.
Yeah, it ended up being a good trade. And these trades, look, they don't always work. You know what I mean? The thing I'd like to say is the commitment to trader is not a predictor of markets, right? Which is why a lot of people don't like to use it, because they'll go, oh, well, this has not done a great job of predicting. But what it is it's a great risk manager, because when people are crowded and the market turns, you can get a huge trade, right? My trades, I've talked about this a number of times. I have about over 20 years of history of doing this. About 38% of my trades are profitable, which means that, 62 are not profitable. But, my winning trades tend to be 4 times my losing trades. So if I can make 4 to 1 and do that 38% of the time, then over time, the math adds up very nicely. And I think on the other side too, it can help, even if you don't necessarily trade this way. There's a lot of times if you're watching the commitments of traders where you might have a certain trade on and it can at least get you out. You might not have to do whatever, but it might at least help you say, hey, there's a lot of risk here that if this thing turns, it could turn huge. And I don't want to get caught up in that. So I'm just going to take my profit here,
So we talked about already what to buy, what tools you use, and how to determine it when you look to make that purchase. Now comes a very important part of the trading process. And this is honestly, in my opinion, you could be wrong 70% of the time, 80% of the time, and still end up making money, but it comes down to, how much to buy. So position sizing. So when you're looking at these specific trades, how are you kind of analyzing your portfolio and putting on a specific position? Do you have multiple on at a time? Or are you kind of balls to the wall, all in on a specific trade? How does it work for you?
No, I think that this is the most important part of all of it, right? I think that every good trader understands that it's not necessarily about predicting the direction of the market, right? It's about having good risk reward, which is what, like I say, I think the commitment traders helps give. But then for me, it's nice because, so here's a day where I'm looking to buy something. You get this bad news, market goes down, closes up, I buy. I'm picking a turn, okay? So if it goes through that low, right? Well, then I didn't pick the turn. If a market makes a new low, then I didn't pick the turn. So I'm wrong. So I get out. It gives me a very defined place of where I get out, right? Which again, people should do with anything they do. Know where you're wrong based on your process. Where is it wrong? Know that. And therefore get out, right? So I know where I'm getting out. I know where I got in. I know how much I want to risk per trade. So I know how to size it, right? There's just a difference between my entry and my stop. I size the trade. For me, I risk 70 basis points a trade, which is just my choice. I have found that that's what gets me to the volatility of my portfolio that I like it to be at. And so it makes it very simple for me. You know, it's a very simple answer to where am I wrong? Well, I'm picking a turn. It made a new low. I'm wrong, right? And therefore, that becomes very simple for me to size my trades because, again, here's where I'm getting in. Here's where I'm getting out. Here's what I want to risk per trade. Here's what I put on. It becomes very, very simple. I don't add to it as I go. I don't take partial profits as it goes in my favor. I just put it on, and then I either get stopped out or I end up making money. And where I get out, again, goes right back to what is my process trying to capture, right? I'm trying to capture that people are very crowded short here. So I'm going to get long, and the chances are they could get squeezed, right? So if they get squeezed and they get out of those shorts and they are no longer crowded short, which to me is when my index goes back to neutral or 50, right? Then I get out. I take my profit. That's where I take my profit, which all fits in the puzzle of what is my process and what I'm trying to capture. I think that's really the most important thing for people, right? What is your process? And based on that process, where are you wrong? So that's where you should get out. So how are you going to size? And based on your process, where is that no longer valid anymore? So take your profit.
And this kind of ties into the fourth one, which is when to sell. So it's kind of
Right.
combined. I want to dive a little bit more on the how much to buy. You mentioned 70 basis points. Is that your position size is 70 basis points of your portfolio out of the gate, or is it your stop losses? You see your stop loss where it could be, and then you're like, if it's stopped out, I lose 70 basis points of my portfolio.
That's the one.
Okay.
If it's topped out, I will lose 70 basis points in my portfolio. And of course, there's some slippage there,
right?
Because, you know, if it makes a new low on close, then I'm selling. Well, it might go through that new low and then keep going, and you know it gets a little bit further away, so there's some slippage there. So I usually do more like somewhere between 60 and 65 basis points per trade, assuming that there's going to, by definition, be some slippage on the exit.
And when you're
I should say,
when you're approaching the execution of the trade, are you putting your entire trade on at once? Or are you, if it goes against you a little bit, then you scale a little bit more into it as long as it didn't hit the stop, or it's kind of just an execution, let it go?
if the market should be, if I'm looking to get long, bad news comes out, the market should be down and it closes up on the day, I'm buying that close. That's my size. I'm buying that close. I'm buying enough so that if I get stopped at that new low, I'm going to lose 70 basis points. There are occasions where if I'm really kind of feeling it for some reason, that the bad news comes out, the thing gaps down, I might start putting some on during the day, anticipating that it's going to close up on the day. And what that will allow me to do, obviously, is have a little bit bigger size by the time the close comes, right? Because my average will be so much lower than the close. But of course, sometimes it doesn't work. I'll buy a little bit. I'm super careful when I do this, but I'll buy a little bit and it won't rebound by the close. And therefore, I just have to get out of it, you know? Okay. Trade didn't work, you know, it didn't happen the way I wanted it. So I just get out of it. So, but most of the time I'm doing it on the close.
Okay, so that adds a lot of clarity to this. How about when it comes to how much to buy? How many positions? Is there a limit to how many positions you have on or prefer to manage? Or if the setups are there, you're entering into the setups?
If it happens, I take them.
Okay.
And then from there, you know, and that's all individual trade stuff. And that's exactly what my individual trades look like. Every single one of them looks like that. Mm-hmm. But then once I have some trades on, and I don't have like 20 trades on at any one time, but sometimes I'll have 5, 6 trades on at one time. If I have a lot, like 7, 8, 9 trades on one time, that's usually a very good sign, because it means I have a bunch that are in the money, right? Because I can't get 8 trades on at the same time, right? It's just not going to line up that way. But if I start having a portfolio of trades on, I then go kind of to the next risk management level, which is I'm looking at the risk of that portfolio, right? And if I think that the risk is too high on one side, then I'll either trim some of the positions down, or I'll look maybe to take a hedge position on the other side. So in other words, if I get a buy-in, if I'm risking 70 basis points a trade, and I get a buy in the Dow, the S&P, the Russell, and the NASDAQ, and I put all four of those trades on, am I really risking 70 basis points? The answer is no, because those are essentially the same trade, right? So if that kind of thing happens, then I will be reducing the size across that, unless there's something I can find based on crowding and all that, that is, let's say, a risk off trade. Those are all risk on trades, and I can get some kind of risk off trade on the other side, then I can put that on to hedge that portfolio. But one way or the other, I'm not putting that all on, and that's based on just observing the correlations across the markets and all that.
I want to make it very clear here, when the 70 basis points per trade, I want people to understand that, the amount of risk that you're taking, right? It's slow consistency, and then you take the outsized winners to build a portfolio over time. It's not just a quick hit, one-time win where you're risking everything to blow up. I know that you've talked about, blow-ups before. So I once again want to redirect people on what that looks like in your prior podcast. But just, is there any more that you want to add on to the importance of the position sizing?
Position sizing is a risk management tool, right? And that's what this game is about, risk management, right? This idea that it's about predicting the future, this idea that it's about predicting where the markets are going to go, is completely wrong, as it should be, because your chances of doing that over time are pretty close to zero. But you can control your risk. I like to say you have to stick around long enough to get lucky, right? So that's what risk control is all about, and that's what risk management is all about, and that's what position sizing is all about. People are like, do you ever, increase your size because you have a better feeling about this trade than other trades? No, I don't, because my feeling is no better than anybody else's feeling. You know what I mean? My feeling, if anything, is wrong more than right, just like everybody else, right? Because there's all kinds of psychological biases that come into play there and all that. So I don't want to be guilty of that, and I don't want to be slave to that. To me, these trades are all exactly the same, be it in the S&P 500, be it in the 30-year bonds, be it in cocoa, be it in orange juice. It doesn't make a difference to me, right? I find the less I know about these markets, the better off I am.
I like that. That's good right there. Good nugget. So let's talk about the fourth thing that we control, and that's when to sell. You've already mentioned, as far as the stop loss goes, that makes complete sense. Your risk, where you're planning on getting stopped out if the trade goes against you. But how do you specifically know as far as when you take profits? I've heard you say you'd risk about 1 to 4. So if it hits that 4, do you take it all off? Do you take half of it off? How do you approach this?
It's all, again, based on my process, my oscillator.
Oh.
Oscillator's at 0, I get long. I hold. If I'm making money, if I don't get stopped, I just ride it. And when my oscillator gets to 50, which is neutral, then my edge is gone. So I take my profit right there. Oscillator gets to 50, I'm out.
Okay.
Like I said, the edge is gone. What is it that you're playing? I'm playing that edge, right? I'm playing that crowded edge. So when it's no longer crowded, I'm out. How long does that take? On average, it's about 2 to 3 months, but I've seen it be 2 to 3 weeks. And I've had one trade that lasted over a year and a half one time. So that's really not up to me, right? That's up to everybody else. When do they want to get out of these shorts? And when they do, I'll give it to them. I'll take it from them down here when they're panicking short, and when they're getting out of those shorts, I'll give it back to them.
So no matter what, if the oscillator hits 50, positions over, ending, and you're going to move on to the next.
Yes.
Okay. I mean, that's pretty simple. Simple. I mean, it's just very basic, very well process driven there. Yeah, I guess it's the
only way I have learned to make money is process driven. That's what this really has to be all about. I've been doing this now for about 22 years, but I traded for 10, 12 years before I did this, and went through what everybody went through, make, lose, make, lose, make, lose. And after 10 years, you're getting that nowhere. If that's what you want to do, then by all means, whip it around, wing it, and play the game and have fun, and look at all this stuff and get it right sometimes, get it wrong sometimes, and lots of fun, but a big waste of time. And after 10 years, I came to that conclusion. Like, okay, here I am 10 years later. I've had a bunch of fun, but meanwhile, I'm in the same place I was where I started. So what's the point, right? Which, if it's a hobby, then that's fine, right? If you have a good job and you're making a good living, and you're not counting on your trading P&L, and trading is more of like kind of betting on sports where you pretty much know you're not really going to lose money, but it makes it interesting and gives you something fun to do, then that's one thing. I can't afford that because this is my living. So, I have to have a process.
Awesome. All right. So we went
and
over
pray that process works.
Yeah. Which it seems like over time, 30 plus years of doing this, it seems like you're well on your path of clear success.
It's been working, but look, you always got to be cognizant of, it stopped working, right? I mean, I'm consistently monitoring my returns and monitoring my portfolio to make sure that this month I'm going to have a pretty shit month of August, but it's well within expectations. It's not like it doesn't hurt. It hurts. Do I sit here every day and say, oh my God, I suck at this and what the hell am I doing? This is after 20 years. I haven't had a down year now in 21 years, right? But I have a down month, which is complete. I usually have 2 to 3, sometimes up to 4 down months during the year. But it doesn't matter. I have a down month this month, which is well within expectations. And I'm still like, oh my God, my process doesn't work. I suck. I don't know what I'm doing. We all go through this, right? But you can't let it affect you. Go through it and go have a beer or whatever and talk to your friends and cry in your beer. I always say I just call my mommy because my mommy loves me no matter what. But you have to monitor. The point was you have to monitor the process to make sure that it is staying within expectations. So I had a down month this month. Realistically, psychologically, I sit here and I cry like a baby. But realistically, I go and I look at it and I say, look, is there anything that is outside of expectations here? Okay, I'm going to lose whatever 65 basis points this month. And I had this many trades, it didn't work. And is that outside of expectations? Should I have X number of losing trades in a row? Is that normal? And the answer to this point has been, it's all within normal expectations. So I'm not changing anything. I can't wait until I find the process that gets 100% of trades right and makes money every single time and every single month. I can't wait. But until I get there, I have to just monitor what I'm doing and make sure that it's fitting within expectations.
I think
and P&L is the answer. P&L is the answer to everything, right? Everyone's like, oh, well, how do you know if your stuff's working? I mean, P&L, right? And you can sit here and make a ton of excuses, right? But the bottom line is the P&L tells all. So if you're going to argue with P&L, then you're just in the wrong. You're in the wrong business. You're doing the wrong thing, right? Oh well, the market just has it wrong, and I have it right, and I'm just early. No, I'm sorry, that's just not it. Your P&L should tell the story.
Yeah, and there's a very key thing kind of that I just pulled from that is sometimes market conditions obviously change, but that's something that we have zero control of. So as you said, you have a down month, and what's so important about what you're doing within a down month is you're sticking to your process that has been proven for yourself over the course of time. Whereas, a lot of other people that I've seen, they start looking at a new indicator or they go to a different process and they're trying to adapt to whatever the market is doing at that specific time with their current strategy. So
yeah, it's funny. I have a newsletter service now that I started after the Market Wizards book came out. A lot of people were coming to me asking me, if I could help them, all that. And one of them ended up starting this service where we have a Discord and a newsletter. And I try to focus this whole thing on trying to help people learn about trading, right? I know a lot of people sign up for services and they're looking for someone to tell them, buy this here, sell this here, buy that, and that's not what I'm looking to do. Now, I do put my trades on there because I am talking a lot about my process on there, and therefore here's my trades. But I beg these people to not just mimic me, right? And it gets to what you're talking about. I say, because this is what's going to happen. I can tell you, right? No one wants to listen to me, but I am 56 years old. I have been doing this for over 30 something years, right? 35 years. I've worked in a lot of different places. I have been exposed to a lot of different traders, a lot of different personalities. And I tell them what's going to happen is you're going to join and you're going to mimic my trades because you figure, hey, I'm a market wizard and I've got these good returns and I'll just try to get his returns. Okay, great. And then the first 3 trades will lose. Okay, so we'll lose. Let's say you're risking 1% a trade. So you'll be down 3%. And I'm risking 75, 70 base points trade. But let's just say I'm risking a percent a trade. Okay, so I'm down 3%. You're down 3%. Now you, as somebody who doesn't know anything about me other than, hey, you read some book or whatever, and there's some hype, right? Are going to say, this guy doesn't know what he's talking about. Okay, I've been burned before and I'm getting burned now. So I am not going to listen to him until he starts proving himself. And then, of course, the next trade you won't take and it will work. right? And I'll make 5%. So now we're 4 trades into it. I'm up 2%. You're down 3%, right? There's a 5% difference already after 4 trades, right? And it's going to consistently be like that because of the fact that it's not your process. You didn't develop it. You haven't been doing it for 20 years, right? So you're not comfortable with it, right? So this is to your point of what you're saying, right? To switch around. Now you'll drop me after, and then you'll go get another guy and he'll tell you what to do. You know what I mean? Like it'll never end, right? You can't make money all the time, right? It's just reality. Nobody ever has, and nobody ever will. Okay, you name them: George Soros, Stanley Druckenmiller, Paul Tudor Jones, Bruce Kovner. None of them, Warren Buffett, right? None of them have made money all the time, right? They make money over time. That's got to be the idea of this, right? Make money over time. Not all the time. It's impossible, right? I just had an argument with a guy 3 days ago where I managed money for this one multi-strategy hedge fund, and they allocated me some money outside of it as an outside manager. And they had a tough month this month, as I did, as a lot of people did. And the risk manager, who of course is a typical risk manager on Wall Street, super smart guy, he's got 85 PhDs, but he's never managed money in his life, and he doesn't understand the psychological side of it. He's like, look, we have to try and make money every single day. I'm like, that's wrong, dude. Okay, it's impossible. It's fucking impossible, man. Excuse my language, right? Like, that's not the view. The view is you have to make money over time, man. You know what I mean? And sometimes part of making money over time is losing some money sometimes. Yeah. And I'm talking to myself here too, okay? Because I'm down in dumps, having a bad month and all that crap, right? But I consistently tell myself this. Last night I sat up, I'm telling you, for 3 hours going through this conversation in my head. It's okay. You know what? And it's because this is the first down month I've had all year, right? So it gets to the point where you're like, oh, I'm never going to have a down month again, right? And then as soon as you have one, it's like, oh, you go into this deep depression. But the truth is, it's part of the game. You know, there is no 100%. You know, you have to just watch your downside, maximize your upside, and let time pass. If I was flipping coins, I always use the coin flipping thing, but here's another way to do it. If I was flipping coins with you and I was getting paid 60 cents for heads and paying you 40 cents for tails, right? I would win over time. No question about it, right? Yeah. But tails would come up, okay? And I would have to pay you 40 cents, a whole bunch. It'll come up 50% of the time. I'll lose 50% of the time. But I know damn well that over time I'm making money on that bet, right? You know it. That's a fact, absolutely. Right? Yeah. So you just have to accept it, you know. And again, I'm telling myself this right now because the month's ending and I have to go send my stuff to my accountant and be embarrassed. And I'm sending my accountant and I lost money and he's gonna, you know, send me my returns and be like, oh, you suck. So you know, my clients are all gonna tell me I suck, but and they never do. You know, none of this ever really happens. My clients, fortunately, I have a very good set of clients, fully understand this, fully understand what I do, and fully understand that you don't make money every month. So. Yeah.
Jason, thanks for coming on to the show. Is there any last parting words maybe to somebody that's been in the game for a while, find themselves a little stuck, hard to kind of make money? Just any other words of encouragement or little nuggets?
This is very, 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 very hard. You know, making money in the markets over time as a trader. You know, if you're a buy and hold guy, right, and you're willing to accept the drawdowns that the S&P will give you every once in a while, right, that's a different story. If you're trying to trade the markets long and short and in and out, it's extremely hard to do. All right. So you have to realize that, A. And B, I think you have to ask yourself, what is it that I'm doing that's different than other people? Because if most people are going to lose money doing this, I damn well better be doing something different than them. Because, you know, get over yourself is what I like to say, right? You're not smarter than everybody else. I know we all like to think we are. We all want to think that we're special, and we all want to think that we're the ones that can do this, right? But the truth is there's a normal distribution curve, and I promise you, you fit in it, okay? Just like I do, just like we all do, right? So you better be doing some, and the problem with the normal distribution curve is if you put a P&L of trading around that normal distribution curve, it's negative, right? So you better be doing something different than what everybody in that curve is doing. And I can promise you, buying a breakout, you know what I mean, buying support at the 30-day moving average, whatever all those things are, that ain't it. I'm sorry to tell you, that ain't it. That's not different than what everybody else is doing. That is what everybody else is doing. And they're all churning themselves to death and losing money. So you have to be honest about this whole thing. And you really have to look into yourself and ask yourself, what am I doing that's different so that I can actually make money rather than just churn this whole thing away like everybody else does?
Jason, once again, thank you for coming on. We really appreciate it.
Okay, thanks for having me.